How should you invest your first $1,000 in the stock market or any $1,000? Maybe you're a beginner investor first moving into the market and you're excited but you're nervous, or maybe you just got an extra paycheck or a bonus at the end of the year and you want to know how to best utilize your $1,000 in this market. And that's the key word, because I believe that the market that we're in is a little bit different than the market, say, 10 years ago. So let's talk about that, let's discuss that, and let's give you a better perspective on how to spend, really how to invest your money in today's market. My name is Derek, and I got my degree in finance. You don't have to. And for basically the last decade, I've been investing my money in the market in one form or another, and I want to share with you, speaking from that experience as well as that education. So when it comes to investing, we have to also realize that if you're investing $1,000, that might be a lot different than you're investing $100,000 or $10,000. So what I'm going to do is I'm going to break this up into two separate scenarios. The first scenario is scalable, which means that if you're investing $1,000, $5,000, or $10,000 or beyond, this will work for you regardless. The second, I will say that it is not scalable. This is like if you had a $1,000 bonus, or if you had your first $1,000 and you're young and you want to be a little bit more adventurous or not risk adverse, then we'll talk about that as well, because I think that they fall into different camps. Now, for 99% of people, if you are brand new to the market or you're adding at the end of the year your bonus, what you should do is you should very much focus on a well-diversified portfolio, first and foremost. Second, you should focus on what are known as ETFs or exchange-traded funds. And third, you should focus on funds that track either the general market, provide a dividend, or track a sector in the market. All right, because there are so many there are so many ETFs out there, but if you stick with those, you'll do well. You also need to understand the concept of correlated assets and non-correlated assets. That's a little bit more advanced, but if you're going to invest your money, it's something that you should probably understand. When you are investing money, it is always more beneficial and it gives you risk protection from the downside if you invest in assets that are non-correlated. All right. So for example, if you have, let's say you invest in the NASDAQ, okay? And let's say you invest in a NASDAQ tracking fund, okay? And then you go and you invest in VGT. They're both ETFs, right? But maybe they're called something different. Maybe there's a NASDAQ specific fund. The problem is the NASDAQ tracks tech-heavy, it's a tech-heavy index anyway. And then VGT is a tech-specific ETF. So those would be non-correlated assets. That means that in the scenario where tech goes down, your entire portfolio will go down. Whereas opposed, let's say you had VGT, which is a tech-heavy ETF, and then you had NOBL, right, which is a dividend aristocrats, which are basically the complete opposite. One is established companies providing dividends. One is very tech heavy. In that scenario, if something happens in the tech sector, right, for example, we know that high interest rates very much affect the tech sector. That might not affect the overall general market. So if you have non-correlated assets in your portfolio, your entire portfolio won't swing as much. Now, for some, that may matter. For some, that may not. And that is called your risk tolerance. Some people are more risk tolerant than others. Some people are also getting closer to retirement than others. If you are brand new to the market and you are young, you might have a higher risk tolerance than someone who is approaching retirement. Why? Because time is on your side if you are further away from retirement. You can be more risky because you can absorb those swings in the market, and in 30, 40 years, your portfolio will be okay. But if you are someone who is close to retirement and you only have 5 years until you're going to need that money, you cannot afford those large swings, because a market cycle is anywhere from 5 to 10 years, really closer to 10 years. And if you get stuck at the bottom of that market cycle when you are retiring, you're going to be in trouble, which is also why, and this brings me to my next point, which is also why we tend to move our money from stocks to bonds as we age and as we approach retirement, because bonds tend to be safer. But we're talking about $1,000. So what do we know so far? We know that you should be diverse, and we know that you should most likely stick to index tracking funds for their affordability as well as their diversification, because a well-diversified portfolio is a good portfolio. So if it were me, and I'm going to invest $1,000, scalable, which means $1,000, $5,000, $10,000, what would I do? Well, the majority of my money would go into a broad general market tracking fund, most likely tracking the S&P 500, not the Dow Jones. All right, I would track the S&P 500, and some good ones are, for example, the VOO. That's a really, really good one, a really popular one, as well as the SPY. Those both track the S&P 500, and they're both low expense ratio. When we say expense ratio, we mean how much money the fund charges to manage your money, basically. All right, and that's why ETFs are so great, because their expense ratio is much lower than a mutual fund. Okay, so the VOO or the SPY would make up the bulk of my portfolio. Then we have to kind of go into, what do I understand? What you understand, what I understand might be completely different. I love tech and I have a lot of experience in tech just using it. So I would then, my next largest position would probably be in a tech tracking fund like the VGT. I would stay away from more niche-based funds or more, how would I say this, eccentric funds like ARK or something of that nature. I'd probably stay away from that, and I would move more towards something that is broad and that tracks the tech sector in general. This is scalable because you're investing in ETFs that are broad-based, and whether you're investing $1,000 or $10,000, as long as you have a long time horizon, 5 years or beyond, you should be okay, because you're giving your portfolio time to move with the market. Now, let's talk about if I have $1,000 and I'm a little less risk adverse, okay? Or excuse me, I'm a little less risk adverse, and I want to I want to be able to make a little more money quickly, at least have the potential to do so. In that scenario, and this is where I don't think this is as scalable, because the general guidelines for a good quality portfolio is to limit your stock picking. That means individual stock picking to around 10% or less. All right, that means if you go out there and you're going to pick 5 or 6 specific stocks, you want to keep 10% or less of this in your overall portfolio. Now, if you look at someone like Warren Buffett or something, they and Berkshire Hathaway, he is picking individual stocks all the time. The difference is he understands fundamental analysis better than most people. Now, anyone can learn fundamental analysis and anyone can use fundamental analysis, but if you're going to individually pick stocks, you should understand it. You should understand discounted cash flows like the back of your hand. You should really understand that, because discounted cash flows, okay, DCF for short, is one of the cornerstones to fundamental analysis, which is basically, to give you a brief synopsis, it is projecting revenues into the future. Okay, so basically guessing, which would be basically educated guessing, revenues into the future, okay, and then discounting them back to today. What we mean by that is, remember that interest rates, that there is this thing called time value of money, right? It's what interest rates are based on, and your return is based on time value of money. So what that means is that money earned 10 years from now is worth less than money earned today. Now, this is a little complicated, but basically what you do is you project what you think the company will make in the next 10 years, let's say. Okay. After that, there tends to be an infinite ratio that's used. Okay. So you project that for the next 10 years, and then you discount it back to today, because money earned in the 10th year is going to be worth less than money earned in the 9th year. Money earned in the 9th year is going to be worth less than money earned in the 8th year, and so forth. So discounted cash flows will give you a valuation for the company. Okay. Then you find the market share of that company, you divide the discounted cash flows by the market share, and you can get a market price for the stock. That is fundamental analysis, and that is a cornerstone to fundamental analysis. And you're probably scratching your head right now, especially if you don't know this type of stuff, and you're saying, whoa, like, what are you talking about? So just so you understand, if you're going to pick stocks individually, like anything, it is a skill that needs to be learned and honed, okay? Fundamental analysis is a skill that needs to be learned and honed. And we're not even touching on technical analysis. That's a whole nother field, which I'm very fluent in. If you know me from Instagram, etc., you know that I'm fluent in that. But we're gonna leave that out, because we're sticking more to the investing side, not the trading side. So we have 2 coins. We have Broad-based ETFs, which is good for pretty much 99% of people. If you're brand new to the market, focus on broad-based ETFs. Focus on picking like an index tracking fund like the VOO. There are plenty of others out there. The VOO, the SPY are really good. Okay, then maybe throw in a couple of industry-specific funds that you think industries are going to do well, like tech or let's say the automotive industry as it booms into electric or whatever. Okay, a battery making industry. You can probably find an ETF for a lot of different industries. Okay, so you can throw some of those in there, but you need to look at the history. You need to look at if they're making money or losing money over the last 10 years. And then I would also include a dividend-based ETF in there as well, because you want to make quarterly or monthly dividends. Okay, NOBL, it's a Dividend Aristocrats, great ETF that basically tracks the dividend aristocrats. These are established companies that provide a dividend, basically a monthly, a quarterly, or a yearly payment to their shareholders, which means you. Now, we're talking about a little more risk involved and you're feeling a little more frisky with the market, okay? Then we're talking really about stock picking in a sense. And in order to stock pick, you need to understand fundamental analysis. So if you want to make outsized returns, you need to learn fundamental analysis. Now, that is topic for another video, which I can make. There are many good videos out there on fundamental analysis. There are also many good books out there, like The Intelligent Investor by Benjamin Graham. An absolute boring read, okay, but a very good quality read if you're serious about this stuff. So I guess two camps. Scalable. The other one is not so scalable because for the average Joe like you or I, or the average Jane, we want to stick with broad-based and diversified portfolios. So stock picking, not necessarily scalable. And the reason I say that is the 10% rule, right? You want to stock pick maybe 10% or less of your total portfolio. So if you have a $10,000 portfolio, about $1,000 you can afford to pick stocks with. If you have a $100,000 portfolio, $10,000 or less is where you want to stay when it comes to picking stocks, okay? Obviously, the more stocks that you pick that do well, the better you're going to do. But then on the same time, you can be like Kathy, who owns ARK Investments, and you can be very well educated in a subject, and you can get absolutely brutalized by the market because the market doesn't give a shit who you are or who I am or who she is. The market just does what it does, and you can go and you can look up ARKK and you can see that fund. Now, she has conviction in her beliefs, and maybe in 5 or 10 years that fund is doing great. All I'm saying is the swings can be massive. So just remember that when it comes to picking your own stocks. I probably just blabbered. I'm kind of doing a little bit both on YouTube. I'm doing some videos where like it's very structured. I script it and it's all cut and edited neatly. And then I really think that there's a need for just having a conversation, and that's basically what this was. I just wanted to have a conversation with you guys and kind of just let you know my thoughts when it comes to investing in the market in general. And I hope you enjoyed this. If you enjoyed this, let me know. We'll have more conversations like this. The thing about conversations like this, you have to understand, I can make mistakes. It's not edited, right? And I love this stuff. It's been my passion for a decade, but the information's coming from up here. So if I make a mistake, please bear with me. If I catch it, I'll try to put it in the description, etc. But I just speak from experience and from my education. I do have my degree in finance, and I just kind of speak to you guys. So if you like these types of videos, let me know in the comments. I will put more out there, probably do one a week of these, and then one more structured video where we talk about something serious and we structure it, and I make sure that you learn and everything's, fact checked, etc. Right now I'm just shooting from the hip. So I hope you enjoyed this. I hope I didn't just mumble and jumble too much. I hope I actually gave you valuable information. If you have to watch the video again, I understand. Finance in general is complicated, and if you're new to finance or personal finance or investing, it can sound like gibberish. I always say like this: finance, investing, trading, they're all like learning a new language, okay? At first, it just sounds like gibberish. If I don't speak Spanish and I'm learning Spanish, it's going to sound like gibberish. But as I learn, as I read books, as I watch videos, as I practice, right? And Duolingo or whatever the little bird is, the little owl. If I practice, that gibberish will start to sound like an actual language. Finance in general is very similar to that. Discounted cash flows sounds ridiculous, doesn't make any sense, right? Money is worth less 10 years from now than it is today. Doesn't make any sense. But if you dive deep into finance, you'll start to understand it and it will start to make more sense. And that's what this channel is all about. So if you like personal finance, if you like economics, and if you like investing in general, you're in the right place. So please feel free to subscribe if you haven't already. And don't forget to turn on the bell notification so you don't miss the next video. We do videos every Tuesday. Those are usually edited videos. I think this is coming out on a Tuesday. It's not edited, whatever. But usually Tuesdays are going to be like my edited content. And then I'll usually do another video either Wednesday, Thursday, or Friday. It might be a market topic. It might be something that the Fed said. It might be a change in policy. It might be some major bank collapse. I don't know, something major that needs to be talked about immediately. I will give you my perspective and my opinion on that. That'll come Wednesday, Thursday, Friday. But Tuesday is the main content. And it'll be that way for the foreseeable future. Again, my name is Derek, and I got my degree in finance, so you don't have to. If you like personal finance, you are in the right place. This stuff has been my passion for over a decade, and I love being able to share it with you guys. I love just being able to talk and try to share my knowledge, because I think personal finance is a subject that is clearly lacking in this country and in the world. For some reason, it is not taught in schools unless you go to college for it, which blows my mind. So hopefully you can get like a mini degree just here on this channel. Again, I love you guys, and I will see you in the next video.